Welcome back to Investors Point of View. Hello to all our community members, students, and everyone tuning in.
Great to be here.
We are diving deep into the latest financials from Nike. We're looking at their fiscal 2026 second quarter results, which closed back on November 30th.
And our mission today is, pretty straightforward.
Yeah, we're going to take this pretty complex earnings report, break it down, and really get to the bottom of the company's strategic state right now.
Exactly. Is this a strategic pause that's healthy, or is it a sign of some deeper trouble?
So let's start at the top. The top line, at
Okay.
first glance, it looks okay.
It looks flat, let's be honest. Total revenues were $12.4 billion, which is a reported increase of just 1%.
But here's the detail that really matters for you. On a currency-neutral basis, that growth was, well, zero. Absolutely flat.
Which means the actual volume of stuff they sold, shoes, apparel, it didn't grow at all compared to last year once you strip out currency fluctuations.
Okay, so let's unpack this because that flat number is hiding, a major operational earthquake.
It really is.
Management is actively walking back their years-long focus on direct-to-consumer.
The channel that was supposed to be their most profitable. And you see the results of this shift in one place. Wholesale revenues were actually strong.
Right, they were up 8% to $7.5 billion. They're clearly mending fences with their retail partners.
But that gain in wholesale, it came at a punishing cost to the direct side of the business.
A huge cost.
Nike direct revenues, so that's their website and their own stores, fell by 8% reported. That brings it to $4.6 billion.
And the really fascinating part here is the digital channel, Nike brand digital. That's where the pain was deepest.
A staggering drop. It shrank by 14%. And,
Yeah.
well, when you intentionally shrink your highest margin channel, you're just inviting trouble.
And that trouble shows up immediately in profitability. Gross margin, it decreased by 300 basis points.
So for anyone keeping score, that's a full 3 percentage points. It dropped down to 40.6%.
Which is a huge hit.
It is. The report blames this primarily on higher tariffs in North America, which, increases their costs.
But we also have to connect the dots here.
Exactly. When you pivot away from high-margin digital sales and you move towards lower-margin wholesale partners,
Your overall margin is naturally going to get squeezed.
it's a double whammy. You've got external cost pressures and an intentional high-cost strategy shift happening at the same time.
And the bottom line just reflects that pain perfectly. Net income was down 32% to $0.8 billion.
Which brings that diluted earnings per share, the EPS, down 32% as well to 53 cents.
Now, here's where it gets really interesting on the expense side. Despite these huge profit drops, they decided to spend more.
A lot more on branding. Operating overhead was actually down 4%, which is good.
But they juiced demand creation expense. So that's all your marketing. Your celebrity contracts up 13% to $1.3 billion.
So they're clearly spending big money right now to stabilize the brand's image while the core financials are suffering.
Okay, let's shift to geography for a second. The North America region is basically the only thing holding them up.
It is. It's the sole driver of that modest growth, with Nike brand revenues up 9% there.
But the rest of the world is really dragging the results down.
Significantly. Greater China revenues were down a massive 17%. And Asia Pacific and Latin America, that was down 4%.
And we can't ignore the other brands. Converse, their other major shoe line has just, well, it's really underperformed.
Terribly. Revenues down 30% because of declines across all territories. Not a strong platform to launch a comeback from.
And yet management is staying confident. The CEO, Elliott Hill, he's calling this the middle innings of our comeback.
Right. He confirms they are repositioning our business. They know the pain is real, but they're framing it as temporary.
So looking at the balance sheet, there are maybe a few glimmers of hope.
A few, yes. Inventories were down 3% overall. That shows they're successfully clearing out old stock, which is healthy.
And they're still prioritizing shareholders even with earnings down.
Yeah, they returned almost $600 million, $598 million to be exact, to investors through dividends and share buybacks just this quarter.
So what does this all mean for you as a keen observer? We have this major pullback in direct and digital sales, the margin compression, and that 32% drop in earnings. Is this necessary repositioning worth the temporary pain? Or does it signal a longer, harder, and maybe more expensive comeback than management is letting on?
That's the billion-dollar question, isn't it?
Write your opinions in the comment section below. Thanks for being here. For more financial points of view, you are more than welcome to subscribe to our channel and give it a thumbs up. See you on the next one.